Topic explains that third-party risk management involves identifying, assessing, monitoring, and controlling risks arising from relationships with external vendors, service providers, contractors, and business partners. Financial institutions increasingly rely on third parties for critical services such as cloud computing, payment processing, cybersecurity support, data management, and customer operations. Although these partnerships improve efficiency and reduce costs, they also expose institutions to operational, legal, compliance, cybersecurity, and reputational risks. Institutions remain accountable for outsourced activities even when external providers perform operational functions. Effective third-party risk management therefore requires strong governance, continuous oversight, and comprehensive risk assessment frameworks designed to maintain operational resilience and regulatory compliance. Third-party relationships create operational vulnerabilities because disruptions affecting vendors may directly impact institutional performance and customer service. Service provider failures, cyber attacks, financial instability, regulatory violations, or inadequate internal controls can interrupt critical business operations and compromise sensitive information. Financial institutions must identify critical third-party relationships and evaluate the potential consequences of vendor disruptions on operational continuity and financial stability. Concentration risk also represents an important concern because dependence on a small number of vendors may amplify operational exposure during crises. Institutions therefore develop contingency plans, backup arrangements, and recovery procedures to ensure continuity of essential services when third-party providers experience operational difficulties or unexpected failures. Risk assessment and due diligence are central responsibilities within third-party risk management frameworks. Before engaging vendors, institutions evaluate their financial strength, governance structures, cybersecurity capabilities, regulatory history, operational resilience, and internal control systems. Due diligence assessments help organizations determine whether service providers can meet performance expectations and comply with regulatory standards. Contracts and service-level agreements establish responsibilities, performance metrics, reporting obligations, confidentiality requirements, and risk management expectations. Institutions also assess subcontracting arrangements because vendors may rely on additional external providers that introduce further operational complexity. Ongoing monitoring remains essential because vendor risk profiles can evolve over time due to market conditions, technological developments, or organizational changes. Cybersecurity and data protection responsibilities are among the most significant concerns associated with third-party relationships. Vendors frequently have access to sensitive customer information, transaction systems, and institutional infrastructure, creating potential pathways for cyber threats and unauthorized access. Financial institutions must ensure that third parties maintain strong cybersecurity controls, incident response procedures, encryption standards, and access management frameworks. Regular audits, penetration testing, compliance reviews, and security assessments strengthen oversight of vendor technology environments. Regulatory authorities increasingly expect institutions to demonstrate comprehensive third-party cybersecurity governance because weaknesses at external providers may threaten operational resilience and broader financial system stability across interconnected digital networks. Effective third-party risk management requires collaboration among boards of directors, senior management, procurement teams, legal departments, compliance functions, and operational managers. Senior leadership establishes outsourcing policies, defines risk appetite, and ensures accountability for third-party oversight throughout the organization. Institutions must integrate third-party risk management into broader enterprise risk management frameworks and continuously adapt controls to evolving technological, regulatory, and operational challenges. Transparent communication, strong governance structures, and continuous monitoring improve institutional resilience against vendor-related disruptions. Ultimately, successful third-party risk management protects customer trust, supports regulatory compliance, strengthens operational continuity, and enhances long-term organizational stability within increasingly interconnected global financial systems.